When people hear the word investing, they often think of the stock market, high returns, and fast growth. But what if you're not trying to get rich quickly? What if your goal is simply to not lose money, to protect your savings while still earning a bit of interest? That's called capital preservation, and it's one of the most important but overlooked goals in personal finance. In this video, I'll walk you through the safest and smartest ways to invest your money if your top priority is not losing it. These are especially useful for beginners, retirees, or anyone saving for short-term goals like a house, emergency fund, or even a child's education. Stick around till the end, because I'll share one investment most people ignore, yet it's surprisingly effective at protecting your money when used properly. Let's get started. Number 1. High-yield savings accounts. High-yield savings accounts are the foundation of capital preservation. These accounts are just like the savings accounts you already know, but they pay you much more interest. While a regular savings account might offer just 0.01% interest, high-yield accounts can offer 4% or more annually. These accounts are FDIC insured up to $250,000, meaning the U.S. government guarantees your money even if the bank fails. That's why they're one of the safest places to store your cash. For example, let's say you put $10,000 in a high-yield account paying 4.5% interest. That's $450 per year in interest with zero risk of losing your principal. They're also perfect for emergency funds because the money stays liquid. You can access it anytime. Just make sure to check if the bank has any limits on monthly withdrawals or minimum balance requirements. Number 2. Certificates of deposit, CDs. Certificates of deposit, or CDs, are another extremely safe way to grow your money with a fixed return. When you buy a CD, you're lending money to a bank for a fixed period, say 6 months, 1 year, or 3 years. In return, the bank guarantees you a specific interest rate. The longer you agree to lock up your money, the higher your interest rate usually is. If a 12-month CD pays 5% and you deposit $10,000, you'll earn $500 in a year with no risk to your capital, as long as you don't withdraw early. There is a catch. If you need your money before the CD matures, you'll pay an early withdrawal penalty. That's why CDs are great for money you don't need to touch for a while, like saving for a vacation next year or future tuition. Number 3. Treasury securities. Treasury securities are loans you give to the U.S. government in exchange for interest payments. They're considered some of the safest investments on earth. You can buy Treasury bills, T-bills, Treasury notes, or Treasury bonds depending on how long you want to invest. T-bills are short-term, under 1 year, and often used for short-term capital preservation. For example, a 6-month T-bill might offer 5.2% annualized return right now, much higher than many savings accounts. And the best part? You can buy them directly from treasurydirect.gov without going through a broker or paying any fees. Another great option here is TIPS, Treasury Inflation-Protected Securities. These are designed to rise in value with inflation, helping you protect your purchasing power. Number 4. Money market funds. Money market funds are a type of mutual fund that invests in ultra-safe, short-term assets like government securities and high-grade commercial debt. They're managed by professional fund managers to minimize risk. Unlike money market accounts, which are like bank savings accounts, money market funds are investments you usually access through a brokerage account. Let's say you invest $20,000 in a money market fund with a 4.75% yield. Over the course of a year, you'd earn $950, while the value of your investment remains stable. While they're not FDIC insured, the funds are usually very conservative and used by investors who want to keep their money safe without letting it sit idle. Number 5. Short-term bond. Short-term bond funds invest in bonds that mature in just 1 to 3 years. These are less sensitive to changes in interest rates, making them a safer alternative to long-term bond funds. Why does that matter? When interest rates rise, the value of long-term bonds can fall dramatically, but short-term bonds recover quickly, helping preserve your investment's value. A good example is Vanguard's short-term investment grade fund. It has historically delivered stable returns around 3 or 4%, with very little risk compared to stocks or long-term bonds. These are a great choice if you're okay with some risk in exchange for slightly higher returns than a savings account or CD. Number 6. I-bonds. I-bonds are savings bonds issued by the U.S. government, and they're specifically designed to protect against inflation. Their interest rate adjusts every 6 months based on the inflation rate, making them incredibly valuable in times of rising prices. Let's say inflation is running at 4%, and the fixed rate is 0.9%. You'd be earning a total of 4.9% annually, all while your principal stays safe. You can buy up to $10,000 per person per year through treasurydirect.gov. The money is locked in for 12 months, and if you withdraw before 5 years, you lose the last 3 months of interest. But if you're planning for long-term savings, this is a small price to pay for a safe, inflation-resistant investment. Number 7. Fixed annuities. Fixed annuities are insurance contracts that pay a guaranteed interest rate for a set period. Think of it like a more powerful version of a CD, with longer terms and tax-deferred growth. For example, you could invest $50,000 into a 5-year fixed annuity offering 5.5%. That means $2,750 per year in interest, and you won't pay taxes on the gains until you withdraw. They're a popular option for retirees looking for predictable income and safety. However, be cautious. Annuities are not FDIC insured, so you need to research the insurance company's financial strength before committing. Number 8. Dividend-paying stocks, cautiously. This one isn't purely about safety, but it's worth mentioning. Some large, stable companies have a long history of paying consistent dividends, even during economic downturns. Companies like Johnson & Johnson, Coca-Cola, or utilities like Duke Energy often pay dividends between 2% and 4%. If you hold these stocks for the long term, you benefit from both the dividend income and potential price growth. That said, the stock market always carries risk. Prices can go up and down, especially in the short term. So only consider this option if you're okay with some volatility and are investing for 5 years or longer. Number 9. Stable value funds, stable. Value funds are available through many workplace retirement plans like 401ks. They offer returns similar to short-term bond funds, but with one big benefit: price stability. These funds use insurance contracts to prevent their value from dropping, even if the bond market stumbles. They typically pay 2% to 4% per year with very low risk. They're ideal for people who want to preserve capital in their retirement accounts, especially if they're getting close to retirement and want to reduce risk. If you have access to one through your employer, consider moving a portion of your 401k into it for added security. Number 10. Municipal bonds. Municipal bonds are issued by local or state governments to fund public projects like highways, hospitals, or schools. The biggest advantage: the interest is usually tax-free, especially if you live in the state where the bond is issued. For instance, if you're in a 30% tax bracket, earning 3.5% tax-free from a municipal bond is equivalent to earning around 5% from a taxable bond. They're generally safe, especially if you choose bonds from governments with strong credit ratings, and you can buy them individually or through mutual funds or ETFs that diversify your exposure. Just make sure you understand the difference between general obligation bonds, backed by the government's credit, and revenue bonds, backed by specific B projects. Capital preservation doesn't mean settling for zero growth. With the right tools, you can protect your money and earn a modest return. From simple savings accounts to inflation-protected bonds and even cautious stock investing, there are options for every comfort level. If you're just starting out, the key is matching your money to your time horizon. Need it in a year? Go with a high-yield savings account or CD. Planning for 5 years? Consider I-bonds or short-term bond funds. So now the big question, which one of these safe investments feels right for you? Are you more of a savings account person, or are you ready to try something like a TIPS bond or money market fund? Let me know in the comments. I'd love to hear your thoughts.